For over 6 decades, every rupee earned in India was governed by a single piece of legislation. Then, almost overnight, that entire framework was dismantled. The government completely scrapped the Income Tax Act of 1961, replacing it entirely with the new Income Tax Act of 2025. The official pitch for this overhaul was simplification, and to sell it, policymakers made a highly publicized promise. Your headline income tax slabs for the 2026-2027 fiscal year would stay exactly the same. But keeping those headline rates static served a second purpose. It drew public attention away from the fine print. To make up for the revenue they aren't collecting through direct income tax hikes, the state quietly engineered 7 distinct financial traps into the everyday mechanics of trading, saving, and spending. The sharpest edge of this new rulebook cuts directly into the portfolios of aspirational, middle-class investors. Trading costs surged. STT on futures spiked from 0.02 to 0.05%, a 2.5x multiplier. Next, share buybacks are now taxed as capital gains at a flat 30%. Finally, secondary market sovereign gold bonds lost their exemption, facing capital gains tax at maturity. They also closed a major loophole for leveraged investors. You can no longer deduct interest expenses against your dividend or mutual fund income. Taken together, these 4 policy shifts systematically penalize anyone using leverage, draining wealth from active retail portfolios before it ever hits a bank account. But you don't have to be an active day trader to feel the squeeze. The new costs are baked right into routine errands. Banks like HDFC are tightening cash access. Exceed your free monthly UPI or ATM transaction limit, and you trigger a 23 rupee penalty fee. Meanwhile, Punjab National Bank slashed its daily debit card withdrawal limits down to between 50 and 75,000 rupees, depending on the card. Even your morning coffee is more expensive. By withdrawing customs duty concessions on imported brewing machines, the government effectively raised the operating costs for office pantries and local cafes. And in one of the most targeted moves, the income tax exemption on disability pensions for defense personnel was withdrawn for those retiring on superannuation. Instead of raising broad income tax, the state deployed a network of microfees and eliminated exemptions. It is a calculated, quiet method to extract wealth from daily routines. When you tally up all these individual changes, a clear victor emerges. The State Revenue Department successfully increased its overall tax collection without ever touching the highly scrutinized headline income tax slabs. The entity absorbing that cost is the aspirational middle-class worker, who now pays a higher operational toll at almost every financial touchpoint. For decades, taxpayers juggled overlapping concepts of a financial year and an assessment year. That dual system has collapsed. We now operate under a single block called the tax year, spanning exactly from April 1st, 2026 through March 31st, 2027. To navigate these rules, employees need to verify that their HR departments have updated corporate payroll software immediately to capture newly enhanced meal and education allowance limits. April 1st activated an invisible fee structure across the entire economy. Surviving it requires recognizing hidden costs, adjusting your market strategy, and playing by the new rulebook.